2022 has been a pretty brutal year to be in the market, with the S&P down 20% off of its all-time highs from last year, and the Nasdaq down 35% from its all-time highs. And given that economists believe there's a 7 in 10 chance that we'll experience a recession in 2023, there's certain investments that we may want to stay away from next year. Hey guys, it's Jonathan here. And in this video, we're going to discuss 5 investments you want to stay away from in 2023. So let's get into it. But before we do, I have to make a quick disclaimer that even though, yes, I am a financial advisor, I'm not your personal financial advisor. I don't understand your complex situation or where you're at with life or your risk tolerance. So none of this video is personalized financial advice, and I highly encourage you to get in talks with a financial advisor if you do want some more detail about how some of this information can apply to your situation. So without any further ado, let's get right into it. So the first investment you're going to want to stay away from in 2023 is crypto. And over the past year, the Fed has been actively working to tighten monetary conditions, mostly by raising the federal funds rate. And by raising the federal funds rate, the Federal Reserve has caused the cost of borrowing money to go up as well. Because of this and the fact that we have some of the highest inflation readings in decades, investments that produce near-term cash flow and dividends become better investments overall, not only due to inflation expectations, which we have recently seen start to come down, but also due to the increase and possible future increase of the cost of money as the Federal Reserve continues to hike rates. One thing important to remember is that crypto isn't like investing into a company. So there's no possibility of free cash flow, and there really is no dividends. Now, we have seen in the crypto space a lot of different companies offer yields on different crypto assets. But as we've learned this year, a lot of these yields are not stable. For example, Voyager and BlockFi both offered yields, but they also both went bankrupt as well. So realistically, the yields that you do get on crypto tend to be more in line with the same yields you could get on cash if you were to deposit it in a high interest savings account. And another thing to consider with crypto as well is that a lot of people invested in crypto with the hope that the price will go up if crypto and blockchain technology became more adopted in everyday financial systems. And this really hasn't played out very well as of recently. And we've actually seen the opposite, where people have started to lose trust in crypto, mostly because of a lot of what we've seen with the different bankruptcies at like FTX and BlockFi and Voyager. And also because of the massive volatility that Bitcoin still has to this day. So crypto can do very well if the Fed does decide to U-turn and start cutting rates. But I personally believe that this is a space that still has a lot of headwinds in it in the meantime. And this probably wouldn't be where I would personally put my money in 2023. So the second investment I'd probably stay away from is companies that lose money. Like crypto, these companies don't offer free cash flow and dividends, which makes them a less desirable investment during an inflationary, rising interest rate environment. Another thing to consider when it comes to money losing companies is that if they lose money, they have to fund their operations somehow. And typically the avenue that they go down is either by borrowing money. Remember what I said about borrowing costs and how it's becoming more and more expensive to borrow money. Or B, issuing more shares, which dilutes the current shareholders' positions, which I think is very important because think about it, if you buy shares of the company and the company issues more shares, then you're just going to lose your ownership stake in that company. So it's another downwards pressure for shareholders. And by increasing the amount of money that they borrow, they're also increasing the likelihood that they may go bankrupt, especially if we continue to see rates move up or if rates stay elevated for an extended period of time. So that is something very important to consider when you're buying these kind of stocks. So to put it into perspective, think about it like this. I'm going to list off a name of 5 companies and tell me which one you think has the most likely risk of going bankrupt. So there's Nvidia, Tesla, Taiwan Semiconductors, AMD, and Lemonade. Well, for those of us who follow these stocks, we know that Lemonade is very different from the other 4 stocks that I mentioned, as that Lemonade is a money-losing company and they're a company that has never made a profit. Whereas the rest of these companies not only make a profit, but have very strong margins. And pretty much what you have to consider is the fact that Nvidia right now is down 53% from year to date, whereas Tesla is down 72% in the same time frame. Taiwan Semiconductors is down 43%, AMD is down 60%, and Lemonade is down 70%. What you have to think about is that when it comes to institutional money, which is the big money in Wall Street that does affect the markets and really moves the markets, that they're going to look at this and they're going to think to themselves, okay, why would we buy Lemonade that's only down 70% for the year, but they don't even make money, when we could buy Tesla that does make money and is down 72% for the year? Not only is the upside greater, but the downside is much less because Tesla, again, they make money. So we don't have to worry about bankruptcy as much as we do with a company like Lemonade. And like I said, big money does move the market. So you really have to think about this when you are deciding what to invest in. Now, I think money-losing companies can benefit from Fed U-turn, but they're only going to benefit if they actually stay in business and they don't go bankrupt. So again, this is something that I personally probably will not touch, but it is something to consider if you are buying money-losing companies. So the third investment I would probably stay away from is companies that don't have pricing power. And this continues on the theme with high margins, that you really want to avoid companies that have contracting margins. So in a recessionary environment, these are companies that typically cater to lower or middle class consumers, are companies that sell commoditized products and services, which is pretty much companies that have many competitors in the same space. Usually these are companies that I personally stay away from, no matter what the market is doing, but definitely I don't want to invest in them in a bear market because these factors usually tend to lead to tighter margins, which means that there is a bigger chance of these companies needing to either A, raise more money, or B, take on more debt, which only further exacerbates the problem of low margins. Another investment you may want to stay away from is any kind of lending, banks, or financials companies. And there's really 2 big problems with these kind of companies. The first problem is that heading into recession, lenders tend to like to increase their allowances for credit losses. So pretty much what that is that's the amount of loans the lender believes that they will have to write off in the future. So pretty much they believe that most likely the entity that they lent the money to will eventually fail and not be able to pay back the loan. And in a recession, typically unemployment goes up. And when unemployment goes up, that just increases the chance that most likely loans will be defaulted on. Allowances for credit losses are marked off as an expense on most companies' income statements. So this is something that you have to consider, that the market will factor this in when it is valuing a company that lends out money. The second problem with financials, especially brokerages in a recessionary environment, is that generally speaking, transactions tend to go down. So in a bear market, there's less people who are interested in trading or investing for the long term. And because of this, transactions tend to go down. And most brokerages make a bulk of their revenue through transactions. So when transactions go down, that means less revenue for these companies, which means you're more likely to see their margins contract. So the next investment I would stay away from is any investment into either real estate companies or mortgage lending companies. Even though this industry has taken a substantial beating in 2022, we're heading into 2023 where we've seen transactions decrease on a month-over-month basis for multiple months in a row. And in 2023, I only believe that the effects of what the Federal Reserve has done will only bake into the real estate market even more. Because of this, we'll most likely have less transactions. People have already refinanced or bought their homes at very low interest rates back in 2021 and 2020. which means less transactions, which means less loan originations both on the buy side and the refinance side, which is how most mortgage companies make money. And less transactions means also less commissions, which is how most real estate brokerage companies make money as well. And given how closely tied the real estate market is to interest rates, we'll probably have to wait to see the Fed at least pivot and stop hiking interest rates before we see the situation get better, let alone see them actually U-turn and start cutting rates overall. So that's pretty much all I got for you guys. Thank you so much. Please hit the like and subscribe button if you're not subscribed already, and I'll see you in the next video. Peace.